As faith in the current financial system continues to fall, governments around the world are rushing to roll out their central bank digital currencies, or CBDCs, before their physical fiat currencies collapse. The European Central Bank, or ECB, has been leading the charge in this regard, and it recently published a working paper about its upcoming digital euro, which sheds light on what CBDCs will look like. Today, I'm going to summarize what the ECB's working paper says in simple terms and tell you why CBDCs will be both bullish and bearish for cryptocurrencies. The working paper I'll be summarizing today is titled, quote, "The Economics of a Central Bank Digital Currency." It was published by the ECB earlier this month, and I'll leave a link to the full document in the description if you're interested. Now, if the title didn't give it away, the abstract reiterates that, quote, "This paper provides a structured overview of the burgeoning literature on the economics of CBDC." Those of you who've been keeping up with our videos about CBDCs will know that the economics of them has been the trickiest part of rolling them out, as it would likely bankrupt commercial banks and make it extremely expensive to borrow, among other things. This is something that is tacitly acknowledged in the abstract of this paper, along with the privacy and user preference risks, an understatement given that users will have no privacy and no control over their money in a CBDC system. Next, the authors provide a non-technical summary of the paper, which may sound like something that's redundant to read, but it's always worth going over when analysing these reports, as sometimes the authors will mention something very important in the summary that isn't evident in the main text. In this case, the authors highlight the fact that over 90% of central banks around the world are working on a CBDC, and claim that the interest in CBDCs is due to the decline in cash payments, good joke, and the rise of unspecified digital currencies, which is presumably cryptocurrencies, and not a joke. I say presumably because the authors specify that these digital currencies, quote, "pose significant challenges to the status quo of the current financial system," which is another understatement given that the implicit and explicit purpose of cryptocurrency is to replace the existing financial system. The authors also touch on another major motivation for the rollout of CBDCs, and that's the possibility that a private company like Meta, Google, or Apple could roll out their own digital currency that could quickly grow large enough to challenge the euro, consistent with rhetoric from other central banks. The authors then explicitly state that they would like the ECB's upcoming digital euro to completely replace cash. And some of you may recall that my personal conspiracy theory is that runaway inflation is really a good way to convince the average person to give up their physical bills and adopt a CBDC. At the end of the non-technical summary, the authors stress that everything that's about to be discussed is in the context of a so-called retail CBDC, which will be used by regular folks like you and me, and not a so-called wholesale CBDC, which will be used by select individuals and financial institutions. That's right, the people in power will have their own digital currency system, which I'm sure will be subject to the same programmable rules and lack of privacy as the digital currency system they're looking to impose on the rest of us. Don't get too excited yet, though. We haven't even gotten to the actual working paper. So, the first part of the paper provides a bit of background about digital payments, and there are a few things that stuck out to me here. The first is that the authors immediately identify the three things central banks are afraid of, which are, again, fintech companies, big tech companies, and cryptocurrencies. Central banks are afraid of these entities because they're quite literally disrupting the existing financial system. As far as the central banks are concerned, the only solution is a central bank digital currency, which the authors note would result in, quote, "abrupt and potentially irreversible changes to the financial system." The authors again point to Meta's now failed digital currency, dubbed Diem, formerly known as Libra, as the watershed moment for central banks around the world. Now, we actually did a video about Diem back in the day, and it's definitely worth watching if you have the time, especially since some of Diem's developers are now in the process of creating a crypto project. The link will be in the description. The authors then detail the three things the working paper will focus on: the economics of CBDCs, the implications CBDCs would have on the financial system, and of course the challenges associated with a CBDC rollout. I can't help but be reminded of a sentence from one of the first CBDC reports we covered from the Bank for International Settlements, or BIS, which bluntly stated that, quote, "There might be some measures that may face obstacles to public understanding and acceptance when it comes to CBDCs." I digress. The authors end the introduction by reiterating that the paper does not concern a wholesale CBDC because it would, quote, "entail a less significant change to the status quo of the financial system." Take a second to consider that the status quo of the financial system includes central banks printing money into the accounts of big banks and asset managers, many of which have been caught laundering billions of dollars, while regulators crack down on regular people with strict KYC and AML. The authors also note that, quote, "Our paper largely steers clear of the topics of cryptocurrencies and decentralized finance, probably because an educated reader would look at this technology and think, wow, this is so much better than a CBDC." Anyways, the second part of the paper explores the, quote, "digitization in business and payments," and it covers all the factors that have given rise to CBDCs. The first factor is the gradual shift of economic productivity from the physical to the digital, meaning that more and more money is being made by goods and services that are available partially, if not wholly, online. The authors note Google, Amazon, and Facebook as easy examples here. The authors point out that this rapidly growing digital economy creates serious centralization issues, wherein the first adopters of the technology required to compete in this economy become larger and more monopolistic, eventually making it impossible for new companies to enter the ring. The authors highlight data as a core component of this first-mover advantage. Companies that have been around for longer have a lot more data about user and consumer behavior, and this gives them an edge that new companies will take years to get, if ever. If I'm not mistaken, this is the rationale behind the Digital Markets Act that was recently passed by the European Union, as it focuses on data sharing and transparency by big tech, including with new competitors in the industries they currently dominate. As a fun fact, the European Union passed another bill called the Digital Services Act alongside the Digital Markets Act, which will effectively see the establishment of various ministries of truth in European countries that will decide what's true and what's false online. More about that in the description. Now, the second factor that has given rise to CBDCs is twofold, and the first fold is the gradual decline in cash payments, which the authors admit isn't occurring to nearly the same degree in all European countries. The second fold is more significant, and that's the rapid rise in companies providing more efficient digital payment platforms, aka fintechs, which are often just fancier front ends for the existing financial system. This second fold also includes cryptocurrencies, and here the authors say that BTC is a bad currency because it's too volatile, and that stablecoins don't work because Terra collapsed. That is obviously one hell of a straw man argument, because Terra's UST is nothing like Circle's USDC or Tether's USDT. The authors add that, quote, "The full decentralization of cryptocurrencies comes at the cost of limited scalability and an excessive environmental footprint for consensus mechanisms such as proof of work." Besides the fact that cryptocurrencies can scale with Layer 2 solutions such as the Lightning Network, the claim that proof of work has a, quote, "excessive environmental footprint" is factually incorrect, because crypto mining accounts for just a fraction of a percentage of global carbon emissions and energy use. You can get the facts about that using the link in the description. Naturally, the only solution to the alleged shortcomings of cryptocurrency is a permissioned, i.e. centrally controlled, distributed ledger that's operated by the government and the central bank. This ties into the third part of the paper, and that's the reasons why central banks want to roll out their dystopian digital currencies. The first reason is one that all central banks love to throw around, and that's that central bank money is the safest form of money. The authors then claim that, quote, "As the use of cash is declining, the promise of convertibility at par becomes less and less meaningful," Call me crazy, but this sounds like a justification for the 1% reserve requirement that commercial banks have in the Eurozone. As you might have guessed, this basically means that European banks only need to keep 1% of all their customers' money in cash. A recipe for disaster as winter approaches, no doubt. The second reason why central banks want CBDCs is one that's been mentioned a couple of times already, and that's monetary sovereignty. A CBDC would make it possible for governments to prevent foreign currencies from competing with their national currencies. If you're wondering why governments and central banks don't like this currency competition, it's because it would fundamentally force them to act more responsibly with their spending and printing, which most governments and central banks don't want to do because it benefits them and their friends. As such, just about every country would quickly see its national currency replaced by some foreign currency, likely the US dollar in the form of stablecoins like USDT and USDC, given that this is slowly but surely starting to happen in countries that are experiencing the most inflation. The third reason why central banks want CBDCs is laughable, and that's for privacy protection. What's especially funny is that the authors pose the question, why do people want privacy in payments? Not surprisingly, the first answer they give is for illicit activity. The second answer to why people want privacy in payments is to protect themselves from corporations who want to use their data, or, as the authors call them, quote, monopolists. Believe it or not, but there was absolutely no mention about people wanting privacy in payments to, say, donate to a political party or support protesters, or buy things that governments don't like, such as firearms, cryptocurrency, and apparently also red meat. What's also not surprising is that the authors conclude that the private sector cannot provide any privacy guarantees, which logically means that the public sector is the only one that can, in this case the central bank and the government. What the authors don't say is something that's been said in many other CBDC papers, and that's that privacy would not be possible with a CBDC for this very reason. Now, the fourth reason why central banks want CBDCs is the real reason, in my opinion, and that's to, quote, address market imperfections. In other words, control the economy so that everything is perfect, according to the criteria of the people in power, that is. Obviously, the authors don't say this directly. Instead, they throw around words many in the crypto community are familiar with, such as faster payments and financial inclusion, which even the authors admit a little later on aren't issues in the Eurozone. The authors also mention that a CBDC could be used to address unspecified, quote, moral hazards in the economy, which almost certainly includes political donations, purchasing cryptocurrency, and all that other stuff I mentioned a few moments ago. Then the authors start to tread closer towards the real reason why central banks want CBDCs. Quote, a CBDC introduction may allow governments to improve their control over payment infrastructures. Moreover, quote, a CBDC may provide a more efficient channel for governments to disperse fiscal transfers directly to citizens. And, quote, additional features such as programmability may enhance the efficiency of fiscal policy, for example, through transfers with an expiry date. Those last 2 points are particularly concerning because some CBDC papers have mentioned that requiring CBDCs to pay for taxes or receive emergency aid during a crisis are 2 ways that governments could force their citizens to adopt said CBDCs. As for the programmability, this relates to the explicit plans central banks have to set limits on how much you can buy, where you can buy it, when you can buy it, and even how much you can save using a CBDC. What's scary is that CBDCs are just one component of the future of the financial system that central banks envision, and you can find out what else they want using the link in the description. Anyhow, the fourth part of the paper pertains to how CBDCs would impact monetary policy, which some of you will know is everything the central bank does, namely raising and lowering interest rates and creating money out of thin air for the government, the commercial banks, and their buddies. The authors start by going over some research that suggests commercial banks could get squeezed by a CBDC. This is partially because there wouldn't really be a need for them, and partially because most people would opt to keep their CBDC holdings directly at the central bank for safety reasons. The authors seem to suggest that a solution would be to just have commercial banks compete by raising interest rates offered on CBDC deposits. The question is where these interest rates would come from, and the answer isn't all that obvious. Perhaps pure programmability by the central bank, i.e. printing. Now, another element the authors examine is the effect CBDCs would have on bank capital, which is quite honestly above my pay grade. For what it's worth, the authors note that, quote, the effect of CBDC on banks' profit retention decisions is ambiguous, which suggests that their analysis wasn't conclusive. Next, the authors assess the actual use of CBDCs to modify monetary policy, which the authors claim is, quote, not the main focus of central banks looking to roll out CBDCs. That's because most central banks want CBDCs to act like digital cash. As we've established, however, the ECB does want to use its digital euro to modify monetary policy and also wants it to replace physical cash. As far as I can tell, this is the case with most other central banks as well. Actions speak louder than words, after all. Now, the authors make this clear in the next paragraph, where they note that the ECB would love to use a CBDC to create negative interest rates. And I'll note that this is not the same as the negative interest rates the ECB had until very recently. Whereas negative interest rates with regular currency effectively pay you to borrow, negative interest rates with a CBDC means any currency you don't spend would be slowly but surely destroyed, thereby giving the central bank an uncanny amount of control over the economy. The authors admit that negative interest rates with a CBDC would, quote, require phasing out banknotes to prevent cash hoarding when interest rates on digital currency become negative. Hence why I believe there's a very real possibility that all the fiat inflation we're seeing could be intentional. The authors also admit that, quote, a CBDC carrying a negative interest rate might face adoption obstacles as users would perceive cash as a less costly means of payment. After discussing the possibility of creating different interest rates for different amounts of CBDC holdings, the authors even admit that, quote, such a scheme, however, would be difficult to explain to the public and might impede adoption as well as usability of CBDC for the average consumer, in particular in the presence of alternative private digital means of payment. And this, ladies and gents, is exactly why every country that's rolling out a CBDC is cracking down on cryptocurrency. In addition to killing cash, they must make sure there is no other kind of currency. Otherwise, their CBDCs will not work, and forcing them will accelerate the adoption of alternatives. The authors then touch on something absolutely terrifying, and that's a study which, quote, shows that the central bank can separately target the store of value and the means of exchange function of money by steering the supply of CBDC. Does this mean they're going to go after precious metals too? You tell me. Now, the next paragraph contains an even more disturbing sentence, and that's, quote, amongst the key choices, central banks will need to decide who should be able to use CBDC, whether and how it would be remunerated, and whether its use would be subject to holding or transaction limits. Besides the prospect of putting limits on CBDC holdings and transactions, what makes this sentence so disturbing is that the authors cite Raphael Auer, a member of the Bank for International Settlements, who has written extensively about how central banks should take total control of the financial system. We actually summarized one of his reports about regulatory compliance in DeFi, and you can find out what he proposes using the link in the description. Be warned, you aren't going to like it. Now, thankfully, even the authors know that Raphael's ideas are outlandish, as they proceed to list all the problems that would be associated with putting limits on CBDC holdings and transactions, such as the issue of ensuring these limits are appropriate for the individuals and institutions in question. The authors sum it up with, quote, overall, it can be concluded that although safeguards allow the central bank to better control the amount of CBDC in circulation, they also give rise to wedges that increase the liquidity premium on CBDC and therefore limit the associated welfare gains. The final section in this part is specifically about the, quote, implications for monetary policy implementation. And what the authors say here is pretty interesting. In short, the introduction of a CBDC would cause some percentage of money to flow out of commercial banks into the central bank. In some cases, this would require the central bank to issue loans to commercial banks to ensure they have enough deposits on hand to continue their operations. The problem with this is that it would therefore mean that the loan being issued to the commercial bank by the central bank would be the same as a CBDC, which isn't true because the loan isn't really a real asset, so to speak. As such, quote, the central bank may have to take on private assets in its portfolio. Put simply, a CBDC could force a central bank to start buying stocks and other assets and give them to commercial banks so they stay solvent in the event of excessive withdrawals due to CBDC demand. Mind-blowing, but not surprising. Wall Street needs to get its cut from this Ponzi scheme after all. Now, the central bankers seem to be fine with this setup, as a study the authors cite says, quote, to the extent that a CBDC increases the usefulness of central bank money and draws demand away from private monetary assets, it has the potential to increase the central bank's control over monetary policy and its ability to reap seigniorage. Anything in the name of control. The silver lining is that the central bank's ability to control the economy through a CBDC would be dependent on its adoption, which could again be negatively impacted by the presence of competing CBDCs, cash, and cryptocurrencies. That said, there seems to be some room for symbiosis, as the authors suggest that centralized stablecoins could be backed by CBDCs. This could potentially be bullish for smart contract cryptocurrencies, as they are the rails that stablecoins run on, but I'd rather not see this outcome. And I don't think governments would like to see this outcome either, at least in the United States. That's because most of the stablecoins in circulation are backed by US government debt, and you can learn more about how stablecoins are backed using the link in the description. Anywho, the fifth part of the paper talks about the implications a CBDC would have on financial stability, something that's already been touched on to a limited extent. The authors begin by throwing shade at commercial banks, with sentences such as, quote, banks raise funds in the form of demandable deposits and invest them in illiquid and risky assets. To be fair, the authors mention this in the context of bank runs, which can occur when everyone tries to cash out and the bank is forced to liquidate the assets on its balance sheet. Depending on the assets in question, the liquidation may not be enough to cover the cash that people want to withdraw. As I mentioned earlier, there is a concern that a CBDC would increase the risk of bank runs, as during a time of crisis, everyone would rush to convert their cash into a CBDC, or so the central bankers say. After going over a few simulations of all the different conditions in which a bank run would occur because of a CBDC, the authors turn to another financial stability issue caused by CBDCs, and that's that banks might start loading their balance sheets with more volatile sources of funding to stay afloat in the absence of sufficient consumer deposits. Rather than scrap the CBDC and avoid all the issues discussed so far, the authors propose that central banks put limits on how much CBDC an individual or institution could hold, and reveal that the ECB is actively examining the possibility of such setups. The authors continue building on the idea that the introduction of a CBDC would inspire commercial banks to increase risk-taking to maintain their profitability. The authors again suggest modifying the CBDC such that it would incentivize commercial banks to lend more, thereby increasing their profitability while decreasing risk-taking. At the end of this part, the authors discuss how a CBDC could impact financial stability policies imposed by other central banks and other regulators. What's interesting is that while a CBDC would make it easier to implement financial stability policy due to the rich data that regulators would be able to gather, this data might not be of high quality if, say, limits on CBDC holdings and transfers are imposed. The devil's dilemma, if you will. Now, the sixth part of the paper concerns the policy around and adoption of CBDCs, including how central banks intend on convincing you and me to use their dystopian digital currencies. The authors commence by commending the Bahamas and Nigeria for being the first two countries to roll out their respective central bank digital currencies, while acknowledging that a CBDC might not be appropriate for every country or region. The authors then make a bold claim, and that's, quote, there is no regulatory alternative that promises to eliminate the threat to the two-layer monetary system. Since cash is only available in physical form, it is by construction not fit for the digital age. That's some radical rhetoric right there. And then the authors say the quiet part out loud. Quote, the introduction of digital cash in the form of a CBDC appears to be the only solution to guarantee a smooth continuation of the current monetary system, an admission so significant that it made the crypto headlines. And because cryptocurrency provides an alternative to the current monetary system the central banks are trying to preserve, the authors advise that, quote, public policy must act decisively and in a forward-looking manner, meaning they must crack down before crypto adoption takes off. These concerns around crypto adoption center on stablecoins, which the authors again note as not being feasible alternatives due to Terra's implosion, which is again not representative of the stablecoin niche, nor does it account for all the innovations that are yet to come. The authors highlight Europe's Markets in Crypto Assets, or MiCA bill, as being an example of decisive action on the part of policymakers, given that it sets limits on stablecoin issuance and use. In case you missed the memo, the MiCA bill was recently passed and should become law in the next 1 to 2 years across European countries. You can find out what other crypto clauses it contains using the link in the description. The authors then highlight the upcoming stablecoin bill in the United States that's expected to be presented in September, and acknowledge USDC issuer Circle's intentions to obtain a banking license in the United States, which suggests that USDC could be safe from regulatory scrutiny. The authors also touch on something significant, and that's that the up-and-coming fast payment systems, such as the Federal Reserve's FedNow service, could be a suitable alternative to a CBDC. I'll quickly note that fast payment systems could come with the same dystopian qualities as a CBDC when paired with a digital ID, as per the Bank for International Settlements' own analysis. In terms of adoption, the authors reveal that central banks appear to be terrified of the idea that their CBDCs could be dubbed a failure by the public due to a lack of adoption. Never mind the fact that without adoption, they wouldn't be able to exercise the control of the economy they're actively seeking. The authors float the possibility of convincing merchants to offer discounts on purchases made with CBDCs that would presumably be subsidized by the central bank. On the consumer side, the authors discuss payment trends, including a propensity to use the cheapest payment methods available, and a preference for one-stop-shop payment solutions such as mobile apps. The authors then pivot to privacy and incorrectly state that, quote, die-hard fans of cryptocurrencies view the ability to transact in full anonymity in the digital world as key feature. I say incorrectly because most cryptocurrency blockchains are completely transparent, meaning you can see everything. Moreover, what makes crypto fans die-hard is the realization that crypto makes it possible to transact without the kinds of restrictions that central banks are shamelessly trying to impose with their CBDCs. This is of no concern to the authors, as it's clear they wanted to get this point across. Quote, survey evidence suggests that consumers are aware of privacy issues but do not consider them as primary concerns. I wonder which central bank conducted that study. Now, the authors go on to explain that bundling CBDCs with other financial services might be another way to encourage adoption, before returning to the topic of how a CBDC rollout could affect the reputation of its respective central bank. The authors admit that, quote, the central bank's reputation with the public is key to successfully achieving its primary objective of price stability, and point to the possibility of a hack or cyber attack as being the biggest risk to the bank's reputation in the context of a CBDC. Make no mistake, governments around the world will be actively trying to destroy each other's CBDCs, especially if they're enemies. This is why some countries, such as the United States, are taking it slow on the CBDC front. They want to make sure they have quantum computer resistance and all that fun stuff. What's fascinating is that the authors cite a 1985 study which found that, quote, if central banks come under increased political pressure and adopt the preferences of the general public, they implement policies that lead to excessive inflation. This is relevant to CBDCs because the central bank's control of things like interest rates is expected to cause the average person to pay more attention to monetary policy, which could translate to intense political pressure to make the central bank create more CBDCs than it should for whatever reason. The authors seem to suggest that this same effect could happen in reverse, with the average person putting pressure on politicians to convince the central bank to raise interest rates so that their CBDC savings increase in value. A truly fascinating thought experiment. Naturally, politicians are not exempt from these dynamics, and the authors caution that politicians could be incentivized to pressure the central bank to use its CBDC powers to pursue an ideological agenda. The authors say that this would never happen in Europe because the ECB is independent. I guess they forgot that the ECB is closely aligned with the World Economic Forum and its ongoing Great Reset agenda. More about that in the description. This brings me to the final part of the paper, and that's the conclusion, where the authors point out that privacy is a, quote, complex issue that needs to be addressed, though they note in the very next sentence that it's not optimal because data sharing should happen in addition to KYC and AML. The authors also claim that the issues CBDCs create for commercial banks could be averted with the methods I mentioned earlier, namely modifying the CBDC and making it possible for the central bank to purchase assets to give to the commercial banks to cover the missing consumer deposits. Wild stuff. What's truly wild is that the authors insist that a CBDC will work due to all the theoretical models they discussed that were put together by academics, most of whom have probably never worked a real job in their life and have an economic incentive to publish the kind of results central banks want to see. The authors end the paper by explaining that a successful CBDC rollout comes down to balance. Too much CBDC adoption and the financial system will face issues due to too much centralized control. Too little CBDC adoption and the financial system will face issues due to a lack of centralized control. Now, it should be clear by this point why what was discussed in this paper is both bearish and bullish for cryptocurrency. It's bearish because central banks need to ensure their CBDCs have no competition for a successful rollout, and cryptocurrency is arguably the top competitor. Even if cryptocurrency is not a competitor, it is a viable alternative that the average person could flee to in the event that CBDCs go full dystopian, and this is an option that almost every government doesn't want its citizens to have. At the same time, however, a CBDC rollout is bullish for cryptocurrencies precisely because they are the alternative, and there's only so much governments can do to stop them because all you need to access them is an internet connection. Not all cryptocurrencies are created equal, however. Some, namely smaller cryptocurrencies that use a proof-of-stake consensus mechanism, could quickly succumb to government and central bank pressure that's being exercised by their friends in finance, be it BlackRock or otherwise. This risk is especially relevant to centralized stablecoins like Circle's USDC, which some of you will know is being supported by BlackRock itself. That's why other cryptocurrencies, namely Bitcoin's BTC, could stand to gain on a CBDC rollout, especially if governments start going after other stores of value that are easier to confiscate, such as gold. The only issue with BTC is its transparency, which could be solved with privacy solutions in the future at the Layer 1 or Layer 2 level. In the interim, CBDC rollouts could end up being bullish for privacy coins. Now, it's important to note that all of this assumes that central banks will succeed in rolling out their CBDCs, and that's certainly not guaranteed. In fact, I find it even more likely that they will fail, especially since nobody except select politicians and central bankers are fans of their problematic properties, be it transaction limits or otherwise. Nobody will voluntarily adopt this technology, and that means governments and central banks will have to find some way of making CBDCs the only option. A combination of hyperinflation and successive crises could be the secret, but they'd never stoop that low to get their way, would they? And that's all for today's video about the ECB's CBDC working paper. If you found it as insane as I did, smash that like button. If you want to make sure you don't miss my next summary, subscribe to the channel and ping that notification bell. While you wait for our next video, you can check out our second channel called Coin Bureau Clips, or you can tune in to the Coin Bureau podcast. You can also follow me on TikTok, Twitter, and Instagram and get your daily dose of crypto updates by subscribing to my Telegram. If you want to find out what cryptocurrencies I hold as part of my portfolio and which ones I'll be covering next, subscribe to my weekly newsletter. And if you want to support what we do, head on over to the Coin Bureau merch store and get a hoodie, t-shirt, sweater, or mug that suits you. The links to all these resources and more can be found down in the description. Thank you all so much for watching, and I'll see you next time. Until then, stay cool, stay safe, and stay crypto.